Hello, everybody. My name is Lush Eisner, and welcome to the Canadian Money Talk, the channel about Canadian investing and personal finance. Please like and subscribe. I record 2 videos per week, so make sure you ring the notification bell to get notified each time one comes out. This is my thoughts on market happenings for the week ending March 10, 2023. Looking at the market indexes for the week, the TSX, S&P 500, Dow Jones, Russell 2000, and Nasdaq were all down mostly in the last 5 days of the week, meaning all of them, on increasing fears of interest rate hikes in the US based on Jay Powell's testimony in Washington, where he reiterated further and faster rate hikes for longer. And then on Friday, we had jobs data released, which showed a strong jobs market in Canada and US, likely leading to further inflation, which would cause more interest rate increases. Oil was down as well, and gold was the only thing up this week by about $20 an ounce. Two US banks had significant financial issues, one going into receivership and the other announcing voluntary liquidation. Turning to Canada, the Bank of Canada held rates steady on Wednesday. The question is whether Canada can pause in its interest rate hikes while the US is still raising, especially if inflation is still above 2%. Because of Canadians' indebtedness, which could have a bigger effect on the economy if people started going bankrupt, and the bigger effect of rate hikes in Canada on real estate and real estate's effect on the economy, we have to be careful. However, the US dollar will strengthen if they raise rates and we don't. The question of raising the target from 2% to a higher value has also been dismissed by the central banks. One of the mandates of the central banks is price stability, and changing the target rate would undermine that. Note that Canada is continuing the quantitative tightening, the selling off of government bonds the Bank of Canada had previously been purchasing during the pandemic to bring fixed interest rates down. Selling those bonds is likely to raise interest rates on fixed mortgages. On Friday, Canada reported producing a new 21,800 new jobs in the last month, higher than the 10,000 expected. Turning to real estate, Toronto's benchmark home price rose for the first time in 11 months in February after the Bank of Canada paused its campaign of interest rate hikes. But Toronto home prices are still down 19% from their peak last year. The number of sales increased 8.5% from the previous month. Inventory remains low. Vancouver has its February sales down 33% from the 10-year average. RBC, BMO, and other financial institutions revealed their earnings reporting that they were stockpiling $2.5 billion to cover bad debts this quarter, nearly 7 times more than a year ago. It's less a sign of financial apocalypse than a return to normalcy, they say, now that the last of the COVID subsidies are running out. But a $10 orange juice at the mall and sky-high interest rates don't help. The Real Estate Board of Greater Vancouver reported that Vancouver real estate prices came up 1.1% month over month in February, and sales increased by 76.9%, but still fell far below February of 2022. Turning to the US, the Silicon Valley Bank became the biggest US lender to fail in more than a decade after a tumultuous week that saw an unsuccessful attempt to raise capital and a cash exodus from the tech startups that fueled the lender's rise. The bank experienced a bank run with its customers trying to take out all of their cash, which of course the bank doesn't have on hand. The bank was taken over in receivership by the FDIC. It is San Francisco based, meaning anything to do with Silicon Valley is now suspect. There is no reason to believe there is contagion to other banks or the rest of the economy, but it doesn't stop people from panicking anyway. SVB failed because it invested its clients' money in US Treasuries, which dropped in price thanks to the increasing interest rates in the US. As the startup clients came to withdraw their money, SVB had to sell the treasuries it had bought at a loss, which caused the depositors to become worried, and ask for their deposits back, causing more selling of treasuries at a loss, causing catastrophic losses in the end. SVB was coincidentally coupled with Silvergate Bank failing as well. Silvergate is a Californian bank that operated from 1988 to 2023. The company began providing services for cryptocurrency users in 2016. In November 2022, concerns were raised about Silvergate's health following the fall in cryptocurrency prices and the bankruptcy of FTX. Crypto-friendly Silvergate Bank will, quote, voluntarily liquidate, end quote, its assets and wind down operations, its holding company Silvergate Capital Corp said. Keep in mind that US banks, especially regional banks, fail more frequently than you think, and there is no risk of a crisis or affecting Canadian banks visible at this point. Banks were already among the hardest hit names as Federal Reserve Chair Jerome Powell signaled further rate hikes on Tuesday in his testimony before U.S. congressional legislators. He started by saying, quote, "We've covered a lot of ground," end quote. And he said the full effects of the actions they've already taken are, quote, "yet to be felt," end quote. He countered this with acknowledgement that January data was hotter, though it could be attributed to, quote, "unseasonably warm weather," end quote. And he warned that stopping point for rates in this tightening campaign is now likely to be higher, given the recent data. And they will move faster if warranted. Stocks finished down 1.5% on Tuesday. The Federal Open Market Committee, FOMC, is scheduled to meet on March 21 to 22, and the Fed at its previous meetings indicated that it intends to raise short-term interest rates by another 0.25%, and following the Powell testimony, the bond markets repriced the increase for the March meeting to 0.5%. However, the Fed will also need to digest fresh information on the labor market and inflation that may impact its upcoming rate decision. Investors will be keenly parsing the FOMC meeting announcement accompanying the FOMC decision, while also paying close attention to comments by Fed Chair Powell, who holds a press conference immediately following the meeting announcement. In the Fed previous meeting, Powell acknowledged that disinflationary trend has emerged, but he also cautioned that the Fed will evaluate the labor market and new inflation data for further guidance. As such, it may be more Powell's comments rather than the expected rate hike that move markets and set the tone for the weeks to follow. Note that the bond market's trading indicates the US Fed raise to be at 5.5% by September. US wage inflation is easing off, which is seen as a good thing for overall inflation. The average hourly earnings year over year for February had actual inflation as 4.6%, below the expected 4.7%, but more than the previous month's 4.4%. And the average hourly earnings month over month for February came in at 0.2%, less than the expected 0.3% and less than the previous 0.3%. Interestingly, COVID began 3 years ago, and wages have grown less than overall inflation despite the rampant wage inflation we've been seeing. On Friday, the US reported producing a new 311,000 non-farm jobs for February, higher than the 205,000 expected. Unemployment rate ticked up to 3.6% from the 3.4%, and this was higher than expected. A U.S. Senate bill that would give the Biden administration the power to ban Chinese-owned social video app TikTok got a big, if not surprising, boost this week. The White House on Tuesday endorsed the bipartisan legislation and urged lawmakers to pass it quickly. The bill, dubbed the Restrict Act, would allow the Commerce Secretary to review certain deals, software updates, and data transfers, and then refer them to the president if there was an, quote, undue or unacceptable risk, end quote, to national security. Then the president can take action. Do note that the owners of TikTok, ByteDance, actually has an American and a Chinese version of TikTok called Douyin, and they are structured entirely differently. The American version has its data stored in the US and Singapore and is administered under US laws and regulations. The two platforms don't share data nor management except at the highest level, where the TikTok CEO reports to ByteDance CEO. The question is whether TikTok would ever feel pressure from the Chinese government to hand over data about Americans to the Chinese government. TikTok says they never received a request for American data and would not provide it if they were asked. Now for some bits and pieces. The Chinese National People's Congress ran this week the country's annual parliamentary meeting. The Chinese markets, especially, are worried about the uncertainty around geopolitics, economic policies, regulation, and leadership changes. Xi Jinping does the biggest government reshuffle to tighten his grip on power. There is hope the Congress will, as usual, also introduce economic stimulus. Over the weekend, China announced it would be targeting a 5% growth this year in their GDP. This is fairly conservative, considering the country's GDP target for 2022 was slightly higher than that, even as it still had so-called, quote, zero COVID, end quote, measures in place. China ended up reporting a 3% GDP growth for 2022. Recently, China is booming. After dropping COVID restrictions in January, the world's second largest economy revealed manufacturing is humming at the highest rate in a decade, subway ridership is at pre-pandemic levels, and restaurant spending is up. Vanguard's chief economist estimates that China's economy will grow 5.3% in 2023 compared to the 3% in 2022, and that the risk of global recession is now below 50%, which is nice, even if all this new demand could stroke the inflation fire. And it looks like the 5% GDP growth target is doable. You'll note that China is on the upper end of the world's growth at 5.2% as predicted by the International Monetary Fund for 2023, with only a few places expected to grow more. Canada and the US are on the lower end of the spectrum. The International Energy Agency says that while the global car market did not have a good year in 2022, SUVs were an exception, raising further concerns about their impact on efforts to tackle climate change, according to IEA's new commentary. A strong increase in sales of electric models was not enough to prevent CO2 emissions from SUVs worldwide, reaching almost 1 billion tons in 2022. Global SUV sales also increased despite supply chain obstacles and rising inflation, growing by around 3% between 2021 and 2022. In 2022, SUVs accounted for around 46% of global car sales, with noticeable growth coming in the United States, India, and Europe. Of this, electric made up around 16% of total SUV sales in 2022. Also from the International Energy Agency, wealth, energy use, and the consumption of goods and services are unevenly distributed between different countries and across the world, and CO2 emissions are no exception. A recent commentary by IEA's energy modelers highlights the stark inequalities in CO2 footprints between countries and within them. It shows that the top 1% of emitters globally produce over 1,000 times more CO2 than the bottom 1%. In terms of regional variations, the average North American emitted 11 times more energy-related CO2 than the average African in 2021. If the top 10% of emitters globally maintain their current emission levels from now onwards, they alone will exceed the remaining carbon budget in the IEA's net zero emissions by 2050 scenario by the year 2046. In other words, substantial and rapid action by the biggest emitters is essential to decarbonize fast enough to keep the possibility of limiting global warming to 1.5 degrees Celsius within reach. And finally, I came across a survey of Americans and when they hope to retire. People in their 40s gave the standard response of 65, but it's only 60% likely to happen. As they get older, they figure out they don't have enough saved, so they put the age of 66, expecting to work longer. This has been a better chance of panning out. In their 60s, they look to retire at 70. And because this is pretty close to the current age, the accuracy increases and they actually have a reasonable target. Those in their 70s who are still working will target 75 and are usually right. The problem is the average American's lifespan is 76.4 years, the shortest in 2 decades, according to the Center for Disease Control and Prevention. Don't be like an American when it comes to your retirement. And finally, looking at next week, the companies reporting next week. On Monday, we have Alimentation Couche-Tard. Tuesday, we have Volkswagen. Wednesday, BMW, Franco-Nevada, and Savaria. On Thursday is Adobe and FedEx for an indicator of the strength of the economy. On Friday, we have Algonquin Power, Lithium Americas, and Ballard. Economic events next week. On Tuesday is the big one with the U.S. Consumer Price Index coming in for inflation read to give information to the U.S. Fed for the following week's rate hike. On Wednesday, we have the U.S. Producer Price Index, and on Friday, Canada has the Industrial Product Price Index. That concludes my thoughts and observations for the week. If you have any requests on what you'd like me to cover in future videos, please put that into the comment section. Please like, subscribe, ring the notification bell, and may you have a profitable day.